Good morning and welcome to the ParkBridge Wealth Management Spring Webinar Series. This program is entitled The IRS Issues Final Regulations on Gifts and Bequests from Covered Expatriates. And as always, my name is Jonathan Shenkman, and I'm the President and Chief Investment Officer of ParkBridge Wealth Management. In that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients, and this is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not for profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in a variety of periodicals, including Barron, CNBC, Forbes, Kiplinger, The Wall Street Journal, and Trust and Estates magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles or by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money, and you can listen to that on Apple, Spotify, or wherever you get your podcast. Today, we're privileged to hear from John Kiely from the law firm McDermott, Will and Emery, based in New York City. And by way of background, John focuses his practice on advising high net worth individuals and families on a full range of estate planning and gift planning issues, including the preparation of wills, revocable trusts, spousal lifetime access trust, grantor retained annuity trust, life insurance trust, and qualified personal resident trust. John frequently lectures on diverse estate planning topics, such as gift planning for qualified small business stock under Section 1202, income tax aspects of estate planning, international estate planning, options for illiquid estates and significant estate tax liabilities, and proposed legislation and regulatory actions that could affect wealthy individuals and families. Today, John will be speaking about the IRS issues final regulation on gifts and bequests from covered expatriates. And with that introduction, I will now turn the program over to John.
Thank you, Jonathan. Hello, everyone. And as Jonathan mentioned, today we will be reviewing the recently issued final Treasury regulations for gifts and bequests from covered expatriates. Uh, by way of background, Congress was concerned that wealthy individuals with significant unrealized gains were escaping the U.S. tax system by giving up their U.S. citizenship, moving to a country with a low tax or almost no tax, and then selling their highly appreciated assets. That led to the creation of an exit tax under Code Section 877A, which we will review briefly later. However, there was still a perceived loophole in this, in that if someone renounced their U.S. citizenship and paid the exit tax at their death, there would not be a U.S. estate tax imposed because they were out of the U.S. estate tax regime. Also, the U.S. would not be able to impose a gift tax on that person because they would no longer be subject to the U.S. gift tax regime, which charges the individual making the gift with the gift tax liability. So we have 2801 on the screen, which was enacted in response, and it provides that when a U.S. citizen or resident receives a covered gift or bequest from a covered expatriate, the recipient, not the transferor like our conventional system, is subject to a 40% tax on the value of property received. Now, within that sentence, there are a few concepts of who is a U.S. citizen or resident, what is a covered gift or bequest, and who is a covered expatriate. Well, at the bottom, we see the highlighted text. Covered gift or bequest means property acquired by gift directly or indirectly from a covered expatriate, uh, uh, and property acquired directly or indirectly by reason of the death of a covered expatriate. Now, a U.S. citizen or resident also includes a domestic trust, even if you may not conventionally think of a trust as being a U.S. Citizen. So, who are these fabulously wealthy individuals who meet the definition of a covered expatriate? Well, Code Section 877A2 provides that the exit tax applies to any individuals whose income exceeds a certain threshold for the 5 years before expatriation, and that test is indexed for inflation, has a net worth in excess of $2 million, or in a minor one, fails to certify under penalty of perjury that they have complied with all of the requirements of 877. The average annual net income tax test is now indexed for inflation and is $206,000 for 2025. The section applies to U.S. citizens who relinquished their citizenship on or after June 17, 2008, along with long-term residents who have relinquished their residency status on or after June 17, 2008, an important issue for long-term green card holders who may ultimately decide to leave the United States. The covered expatriate, or CE, as sometimes referred to in this presentation, is subject to a tax on a deemed sale of assets, resulting in tax on unrealized gains in excess of $890,000 in 2025. This was originally $600,000 in the original statute before inflation adjustments. So this was the way to close the perceived loophole. If you want out of the U.S. tax net, you first have to pay capital gains tax on your unrealized gains. There are a few dates to keep in mind. The HART Act, which introduced 2801, was effective June 17, 2008. The enforcement of 2801 was suspended pending issuance of final enabling regulations. There were proposed regulations in September of 2015, and with lightning speed on January 14, 2025, the IRS issued final regulations effective as of January 1, 2025. And as we go through this, you'll want to keep track of two critical dates, June 17, 2008, and January 1, 2025. There are three broad categories of covered bequests in the final regulations. The first category is property acquired by a recipient on or after June 17, 2008, directly or indirectly by reason of the death of a covered expatriate, but only to the extent the property would have been included in the covered expatriate's gross estate if the covered expatriate had been a U.S. citizen immediately before death. Category 2, our covered bequest includes property received from a covered expatriate that would have been included in the covered expatriate's estate, even if not acquired directly or indirectly by reason of the death of the CE, Section 2035 inclusion, for example. The final category is distributions made by reason of the death of the CE from a non-electing foreign trust to the extent that distributions are attributable to covered gifts and covered bequests made to that foreign trust on or after June 17, 2008. So keep an eye on that. Assets added to a trust, a non-electing foreign trust after June 17, 2008, distributions out of that trust after January 1, 2025. The term covered gift has its ordinary gift tax meaning, with minor exceptions for transfers of intangible property by a non-resident who is not a U.S. citizen, transfers to political organizations, transfers of stock to foreign corporations, the per donee exclusion under 2503B, the exclusion for educational and medical expenses, and waiver of pension rights. Now, there's an important point to keep in mind here. There was an argument that 2801 was supposed to make the decision to expatriate tax neutral by eliminating this perceived loophole from the estate and gift tax. In fact, in reality, 2801 will often result in a much, much harsher regime for many individuals than if they had stayed within the U.S. tax system. I imagine that all of you are familiar with the current $13,990,000 exemption amount for estate and gift tax which eliminates that transfer tax for all but the wealthiest individuals. That concept does not exist for purposes of 2801. Also, we're probably all familiar with uh, crummy trusts and the different ways in which we can multiply the benefit of annual exclusion gifts. The Since the way the 2801 tax is applied, it is calculated by the recipient and paid by the recipient, who only gets the benefit of one annual exclusion amount, even if that person receives gifts from multiple covered expatriates in a particular year. Uh, Property acquired by reason of the death of a covered expatriate is one of the type of transfers uh, covered under the definition of covered expatriate, and includes property or an interest in property acquired by reason of the covered expatriate's death. So we have our straightforward, obvious scenarios. There's a bequest under a will to a person from a covered expatriate, very obvious, that is covered by this rule. There may be other transfers that are not what are conventionally thought of as bequests that are still captured by this. For example, property that was titled as joint tenancy with right to survivorship between a covered expatriate and another individual will be subject to these rules, even though there is not a bequest under a will. Also, property passing by a beneficiary designation would enacted by a covered expatriate would be subject to these rules again, even though that's not a a bequest in perhaps the most literal sense of the term. There are also some minor exceptions from what is uh, a covered gift. So those include taxable gifts reported on a timely filed 709. An important exception in the code are ones that were previously partially taxed. For example, if a covered expatriate creates a joint interest with a U.S. citizen, there would be some tax owed at that point, and effectively there is a credit upon the death of the covered expatriate for some of that tax previously paid. A very, very important concept is the income tax deduction for the 2801 tax. The U.S. recipient of a distribution from a non-electing foreign trust is allowed a deduction against income tax in the calendar year in which the U.S. recipient paid or accrued the 2801 tax. This deduction is equal to the portion of the 2801 tax attributable to such distribution, but only to the extent that portion of the distribution is included in the U.S. recipient's gross income, which for this purpose includes accumulation distributions under 665B. So a quick recap on conventional trust income taxation. When a trust makes a distribution of its income for a particular year, the trust has a deduction for that income distribution. A K-1 is issued. The recipient picks up that distribution on their income tax return. There's a special rule for foreign trusts where the accumulated income from prior years is subject to a punitive throwback tax, and there's this accumulation tax for that previously undistributed income that designed to eliminate the benefit of keeping assets offshore and potentially avoiding U.S. income tax for some number of years. So it's very important to keep in mind that if someone is subject to this 2801 tax, that they are also claiming the appropriate deduction on their income tax return. And just to warn about a potential terrible scenario, imagine someone is unaware of the 2801 tax, is aware that they have to pay tax on distributions, continues to pay tax every year on those distributions, and by the time they have discovered they have a 2801 tax liability, well, they will still owe the 2801 tax, but it might be too late to amend their income tax return to claim that deduction. Well, a foreign trust will not necessarily be all or nothing in terms of how it was funded by a covered expatriate. A person may fund a trust while they're not a covered expatriate and after they're a covered expatriate. And multiple individuals may fund a trust, and only some of them may be a covered expatriate. To deal with that situation, the regs have a new ratio. It may remind many of us of the generation skipping transfer tax inclusion ratio. We have a new 2801 ratio to take into account this scenario. So what we would need to do in each situation is if we think there's a possibility, if we think that the trust was funded in part, hopefully in substantial part, with funds from non-covered expatriates, we have to determine the ratio of what portion of it is attributable to those gifts from non-covered expatriates. So that relief sounds wonderful in the abstract, but now coming back down to reality, how on earth is the beneficiary supposed to have that information? Uh, for example, if someone receives a gift from someone who they think is a covered expatriate, are they supposed to say, "Well, wonderful, thank you. I'm also going to want to take a look at some of your past tax returns to determine when it is you might have funded this foreign trust, and to determine whether you are a covered expatriate." In the proposed regulations, there was a very harsh rule that in the absence of adequate records, there was a presumption that the entire distribution is attributable to a covered gift or bequest. So this could be a terrible problem if there was some information about just perhaps a minor amount was from a covered gift or bequest, causing a much larger trust to be subject, all distributions to be subject to this punitive tax. The final regulations soften this, and the presumption can be rebutted to the extent the taxpayer can supply information that the distribution was not entirely attributable to a covered gift or covered bequest. So let's say we have our typical mess where very few records exist, but we can show that upon one person's death who was not a covered expatriate, that person's estate transferred a substantial amount into this foreign trust, which later makes a distribution to a U.S. citizen. It will be very helpful to be able to rebut the presumption, at least as to that significant piece, and reduce the 2801 tax liability. Now, if a foreign trust wants to get out of this regime, it can elect to be a domestic trust. The IRS, just about 8 days ago, released a draft Form 708, which is the form that is going to be used by the recipients to report their 2801 tax liability, and will also be the form that can be used for a foreign trust to elect to be a subject to these 2801, to be a domestic trust for purposes of 2801. So if they make that election going forward, the distribution out to the U.S. recipients will not be subject to this punitive 2801 tax. Well, again, that in the abstract, that sounds lovely. Quick way to just make an election, get out of this punitive tax on future distributions. The U.S. recipient is sure to love that idea. Unfortunately, there's a very hefty toll to benefit from that rule. First, the trustees need to pay the 2801 tax, and in order to pay that 2801 tax correctly, they need to show the computation of the 2801 ratio if they are claiming that any portion of the of the transfer of property in the trust is not from a covered expatriate. There is also ongoing reporting requirements. They need to designate a U.S. agent. They need to provide the IRS with information about all the U.S. Recipients and notify the trust beneficiaries about the election. Also, they must file a Form 708 to report each future covered gift and bequest. The good news and bad news about that is that in a year where no contributions are made to that trust that are covered gifts or requests, they don't need to file a Form 708. But as we know, when people don't need to file a form every single year, inevitably it does not get filed. So while that is a relief from an annual filing requirement, it may end up being an ongoing compliance burden. Now, determining responsibility under 2801. As I alluded to earlier, this is very different than the conventional U.S. regime, where the transferor is responsible for reporting the tax and paying the tax liability. Here it is the responsibility of the U.S. citizen or resident who receives the distribution to determine whether there is a 2801 tax liability uh, and to pay that tax. Uh, and as I alluded to earlier, it may be very difficult for that U.S. person to have the necessary information to make that determination. Now, there is a public list that reports when someone renounces their U.S. citizenship. So, as a first stop, when evaluating this, you would look to that list to see if there is a record of that person uh, renouncing their U.S. citizenship. That in and of itself will not tell you whether that person is wealthy enough to have been a covered expatriate. We are promised that there is a forthcoming Internal Revenue Bulletin on the circumstances in which the IRS may be permitted to disclose taxpayer return information of the donor or donor expatriate to help determine whether the donor or decedent was a covered expatriate. Um, Given the chaos at the IRS, I would not hold my breath waiting for that guidance. We've learned recently in audits on estate and gift tax matters that in the estate and gift tax division, their headcount is already down 30% during the current administration, and it is anticipated to go down another 20%. So staffing is going to be a tremendous problem to even just keep up with core functions. Now, a taxpayer who reasonably concludes that a gift or bequest is not subject to 2801 may file a protective Form 708 to start the statute of limitations for assessment of 2801 tax. This is analogous to a situation where a person made a transfer, perhaps structured as a sale, and they are filing a protective gift tax return to very clearly state this transaction was made, and we are taking the position that it was not a gift, so that the statute of limitations does in fact begin to run, because there's nothing worse than a liability that builds up year after year with interest charges building up year after year. While there's not a clear right or wrong answer, that it could be a good opportunity for someone to at least consider whether this is an appropriate time to make that type of protective Form 708 to start the statute of limitations on assessment if there is a gift that there's a strong possibility that it is not subject to 2801, but perhaps there is some ambiguity. Unfortunately, banks destroy records after 6 to 8 years. So through no fault of the taxpayer, there may simply be some gaps in the records. So why did I point out uh, those timelines of when the statute was enacted and when the final regulations were released? Well, if a person expatriated before June 17, 2008, they cannot be a covered expatriate. So all of their transfers outright to someone or to a foreign trust that has not elected into the 2801 regime is not subject to these punitive rules. If a person expatriated on or after June 17, 2008, they could be a covered expatriate. Now, if let's say this someone is a covered expatriate and they made outright gifts, and let's say they made them in 2009, 10, 11, 12, all the way up through 2024, all outright gifts. Uh, they are in the clear on this 2801 tax. There was significant concern that 2801 liability was going to be retroactive, perhaps at least retroactive to the issuance of the temporary proposed regulations, but that did not occur. However, there is continued significance to that interim period. For example, if a covered expatriate made a transfer to a foreign trust in 2009, 10, 11, any of those years, and that those funds were not transferred out before the issuance of the final regulations in 2025. And now on, let's say, August 1st of this year, there's a distribution out to a U.S. citizen or resident that will be subject to the 2801 tax. So there's continuing relevance to transactions that happened between the enactment of the statute and before the issuance of the final regulations. And as I mentioned, with the now recent issuance of the final form 708, we have a clearer idea of what the reporting is going to look like. So this is another item to add on your checklist when you see a distribution from a foreign trust, or if you know that someone receives distributions from a foreign trust or receives a bequest from overseas, to ask the question about whether that might be from a covered expatriate or it may be traced back to a covered expatriate. And with that, I hope you now have a clearer idea of what the terms mean in this code section, what we mean by a receipt of property by a U.S. citizen or resident, what could be a covered gift or request, and when that might be happen directly or indirectly, how the recipient is responsible for paying the tax at the rate of 40%, both determining the liability and completing the filing, and that a domestic trust, that a U.S. citizen includes a domestic trust. And if you have any questions, feel free to reach out to me at jkiely@mwe.com. And with that, I will turn it back over to Jonathan.
Great. Thank you so much, John. And if anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to John or myself where appropriate. And I'll be sure to also include his contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. And I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Three more quick items before I let you go. First, my next webinar is on Thursday, June 5th at 8:30 a.m. featuring Angelica Herberger and Russell Ephraim, both of CBiz advisors and are based in New York. They're going to be speaking on the topic of understanding pass-through entity taxation. And I'll be sure to send out the invitation to this program in the coming days. In the meantime, I'd love to continue to grow this webinar community. So if you have a friend, colleague, or client who would like to be notified of my upcoming webinars, they can email me with the word webinar in the subject line, and I'll add them to my webinar distribution list. My email is jonathan@parkbridgewealth.com. Second, you could follow all my work on X and Instagram at Jonathan on Money, and by connecting with me on LinkedIn, you could also listen to my weekly podcast called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcasts. And you could also watch my practical planning videos, which I post several times a week. by following me on YouTube at Jonathan on Money as well. And third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.